Thanks everyone for joining us. We're here to have our market outlook call with Jeremy Fehr. And yes, I do realize that everyone attending could probably hear us talking. We started the webinar, and so we had no way to kind of mute it or stop it without restarting it. So I apologize for that, but we're on time here, so we're going to get started. It's Ted Bader here with SI Wealth, and we wanted to set up this webinar because as many of you know, we went into our yellow zone a couple of weeks ago, and we want to just make sure that any questions are answered. Jeremy has an opportunity to talk about current market conditions and what that actually means for SIA and what he's seen in the markets going forward. And in addition to that, Paul Vendrinsky is going to wrap it up very briefly just to mention how going into the yellow zone has affected some of our funds that we manage for BMO. So we thought it was a timely opportunity to just have this webinar. So without further ado, I'll pass it over to Jeremy, but thanks everyone for joining.
Thanks, Ted. Thanks everyone for taking the time this morning and afternoon for you back east. As Ted mentioned, it's been a very, very interesting market over the last number of months. We've seen some volatility as being the norm through most of 2019, especially since May of this year as well. So our last update was in July, and so we're going to talk a little bit today about some changes between now and then and look at some of the same charts and a couple of new charts just to give us an idea of where we're at. First and foremost, we have moved to the yellow zone, so we've got the equity action call chart listed here, and we can see that we moved into the yellow zone, and now that puts us in a cautionary position with all of our investment portfolios. So for those of you who may not be familiar, when we have any sales, if we have any stop losses with any of our positions while we're in the yellow zone, we'll just hold cash. So we get defensive, and with our tactical asset allocation fund, we moved from a 60% exposure to equities, 40% to fixed income, to a 60% exposure to fixed income and 40% exposure to equities. So it is a bit of a risk-off time for us. It doesn't necessarily mean that we are imminently going to go to the red zone where we would use cash or short-term fixed income products to defend against significant downturns. So that doesn't necessarily mean that we're going there. We can see that we did reach the yellow zone as recently as last year in 2018, the latter part of 2018. We saw a yellow zone with a quick rebound in the early part of 2019. So it doesn't necessarily mean we're there, but we need to be cautionary. We need to be a bit more defensive with our actions, and certainly a bit more defensive in our commentary with our clients. Our second level of analysis, let's talk about what really moved us down into the yellow zone. We have on the left side here the asset class rankings from our most recent webinar, July 19th. In that ranking, we can see that U.S. equity is ranked number 1, with international equity number 2, bonds 3rd, Canadian equity 4th, commodities in 5th, cash in 6th, and currency in 7th. The major changes that we've had up until a week and a half ago is really a significant change between currencies in international equity. So we see international equity move all the way from the second position, second rank, down into the 6th. We see currencies come from the 7th position, making its way up to 4th. One of the other beneficiaries, and we had spoke to it in July, was Canadian equity, where we were seeing strength in commodities, not broad-based strength in commodities, but some, such as precious metals, and we'll get to that in a minute. But the major divergence that caused this yellow zone was really that international equity drop and currencies moving up at the same time. So with that change, it really shows us that maybe some of this trade war talk internationally is having an effect on international markets as people take money out of equities and focus currency just being a measurement of fixed income products in another currency outside of US and Canada, as well as some of the Brexit conversation that is really, both of those topics have created some uncertainty over the last 6 months and continue to do so. So I think that's a larger part about what we're seeing in there. We had noticed going into recent months that for a large part of 2019, that most of these asset classes have been very, very close together too. So we've seen significantly close rankings between them. So that it doesn't take a lot of movement to get them going. So the first chart I want to highlight today is our SIA currency EWI versus our SIA international equity EWI. I really want to highlight the change that we've seen since July. So you'll see in the bottom right corner a green circle with an arrow going up. This is the divergence that we've seen as currency has now been improving over international equity. We can know, and it is worth noting, that we are in a significant downtrend for currency versus international. We've seen a couple of times in 2016, in 2011, and of course in 2000 and early part of 2009, where there was still volatility from the '08 crisis. We've seen these rebounds where currency has done better than international equity, but in all cases has continued its bigger long-term downward trend. So we are seeing a shorter-term trend being here, but that's the divergence that we've seen. This is what has caused that differentiation in the ranking, with international equity moving down and currency not moving down. You'll notice in this call so far, I've really focused on those two asset classes, and for good reason. If we look at what's happened on an equity basis and a broad base, we're going to take a look at our SA charts market equal weight index. What's important about this benchmark is that it's taking into account US, international, and Canadian equities all in one place. If you look where we are on the right-hand side, you'll see the green and red line going up and down, the red being small at the bottom with an A beside it. That's our October mark. To the left of it is July. So we're actually in exactly the same position as we were in July on equities as a group. We did see a rally that moved up through August, up and tested resistance at the first resistance line there, and then we've moved back down. So we continue to be in a consolidation pattern, which is where we've been for most of 2019 in equities in general, with the exception of maybe some specific names, but largely on an equal weight basis, equities have been going sideways since February, March of this year. So it hasn't been an easy time to be invested without being narrowly focused or in those mega caps that have had some success. But we can see that a breakout above that 69,633 level would be a significant breakout. We've hit that resistance level just below 4 times already. That's not insignificant. A breakout above this would be bullish. So we still sit in what would be considered a relatively bullish chart. It has the potential of significant breakout if that goes forward. So we'll have to monitor closely. The next chart we're looking at is the SIA US Equity Equal Weight Index. Very, very similar chart to what we were looking back in July. It's actually added another X and now is sitting right at resistance just below that 44,158 level. Again, very similar to what we saw with the market equal weight index. A breakout here has significant upside to it. So again, we're not seeing tremendous weakness across the board. It really has just surfaced in that international side at this time. Of note, there is still weakness in drug sectors. Software, which had been strong the last time we spoke in July, has now weakened off. But to replace it, it was semiconductors. Semiconductors have moved up over the last few months very strongly. The other sectors that are in play for strength are aerospace and defense, leisure, health services, diversified services, and utilities. So we continue to see that. We certainly have seen volatility in those sectors, volatility in the market, but there has not been a significant change in that overall market EWI and U.S. equities, which has been the strongest. NASDAQ is another chart that I've had up quite a bit this year. It has been a leader of note. It has weakened up more than the S&P 500. It has weakened up versus Canadian equity as well. So for the first time in 2019, it's been lagging. Unlike the first two charts that I showed you, we did see a breakout in August where we went above resistance, followed by a downturn here. That downturn has really come from very few names, Facebook, Netflix, and Google. So 3/4 of the FANG index has retraced significantly, moving into the red zone of the NASDAQ 100 report. Only Apple has broke that trend and remains in the green zone. So the chart is overall near-term weak. We see the S-Max in the top left corner is showing us weakness, whereas our broad-based equity indicator in the market EWI and the U.S. equity indicator both are showing green on both of those on a short-term basis. Even we do see a divergence with the NASDAQ. USD CAD, always want to watch this. This can generally speaking, when we're going to see potential crises in the stock market, we will see a US dollar rally versus a lot of other benchmarks. We have seen that versus overseas benchmarks. That's certainly an area where there has been strength in USD CAD, again, playing into that trend that we've seen with international equity to look weaknesses. People take off risk outside of the United States and Canada. The U.S., the Federal Reserve remains dovish. Expectations still lean towards downward movement in interest rates, but they've also signaled strong support for the markets too. So liquidity continues to be a big part of their policy, and that has kept it weak. But looking at the chart, we're essentially exactly in the same spot we were in July. So even with this turmoil we've seen over the last month or so, we still don't see that. So we're still watching the same range. We're watching for that 137 to the upside. To see that breakout would be significant, or that 129.8 would show us some weakness. There is support down above 124.76, but we'll watch near term to see if there's a breakout in either direction on that, but no changes of late. An area which goes against, we did mention Canadian equity has moved up from the 4th position to the 1st position. It has not been on the backs of energy. Energy has sold off from July. If you look on this chart, you can see that I've got a red circle over the 7 in July, and we did see a drop in August, a subsequent strong rally through September and the early part, through September. But October has seen a significant sell-off here. So as crude continues to weaken, we are, though, trading sideways. We are in a range between that 51.87 and that 61.99. So it's a large range, about $10 on crude, but it has weakened up a zero S-Max. So grossly oversold on a near-term basis, but this is an area where weakness has been, and maybe we'll continue to see that, especially for Canadian listed securities. So what has been very helpful for Canadian equities since July has really been precious metals, specifically gold. It's rallied strong. You can see the green circle that I highlighted. We had just seen a breakout in this chart, which is, an extremely bullish chart signal when you see a triple top breakout coming anywhere near its downtrend line and breaking to the upside. So that's a powerful point and figure chart that I'm quite happy to see, especially when we're long in that area. But since then, we've moved up again. So we've gone from that 1,400 range now up into the mid 1,500s. That has been good. There's been a near-term pullback on gold, but it certainly had, and if you look at some of the top-ranked investments within the SIA charts universe, you're going to see a number of precious metal stocks. So that's helped us within the Canadian universe, as well as financial services has been strong as well. So we're just watching precious metals. This is an area of strength. So that really just wraps up. I just wanted to do a brief update. Really in conclusion, we're seeing the weakness in that international market. The trade is going away from equities there, going to safer investments in the fixed income space. This is not dissimilar to what we've seen in North American markets over the last year or so with a strong bond rally. We expect that to be there. The difference here is that equities have not fallen off. They've still seen a little bit of growth over the last little while, and bonds have held in significantly well. So we'll continue to be watching that. At least near term, the yellow zone doesn't look as risky as some of the ones that we've seen back in 2016 or 2008, obviously, as far as where we are today. So we're not in panic mode at SIA, but certainly being cautious. I did want to highlight some of the products that have had, we think, or think offer great opportunities during a yellow zone. We've got the BMO SIA Focused Canadian Equity Fund. Obviously, with Canada being ranked #1, this is an important product. What's useful about it from your point of view is that the active share is 90%, so 90% of the holdings do not reflect the index, the underlying benchmark there. We've been finding that our clients have found this is a good sleeve, a 25% sleeve within their Canadian equity portfolios, but certainly one to watch and to be active with. The BMO Tactical Global Bond ETF Fund, this is a product that we launched a number of years ago, has responded very strongly. Relative strength has worked extremely well over the last couple of years in this area, keeping us to the mid and longer end of the range, as most people were speculating in longer interest rates. What's important about this too in the yellow zone is it's investment grade bonds only, so that reduces the risk if this equity market continues to weaken. And we're seeing again a 25% sleeve of this in a bond portfolio makes a tremendous amount of sense. And then finally, our top selling fund, the BMO Tactical Global Asset Allocation ETF Fund. Now that we've moved to the yellow zone, this product has moved from being 60% equity to 60% fixed income. So that's dramatically reduced the risk profile. It tends to be an all-in-one solution, but also a sleeve to get your overall asset allocation down when we get into yellow zones and riskier places. So I'll take some questions on this at the end of the presentation. I'm now going to shift it over to Paul Vendrinsky, our portfolio manager with all of our BMO products. So Paul, if you could take over at this time.
Thanks a lot, Jeremy. What I wanted to go through here is to look at our 5 separate funds we have right now with BMO GAM and just kind of go over what has changed or what hasn't changed with what Jeremy just went over, specifically the equity action call moving to the yellow zone. So if we go to the next slide here, this just gives us our macro to micro view. Jeremy, are you able to switch the slide? Well, the next slide here, right here, sorry. It gives you a brief view from our top-down approach, starting off with the macro view. Do we want to own equities? This is that equity action call, all the way down to our individual selections, whether it's ETFs or individual stocks. And this is the same process that takes place really with all of our portfolios. If we jump to the next slide, this is our as Jeremy mentioned, our most popular fund. This is the BMO Tactical Global Asset Allocation Fund. So I was going to talk about how this changed with the equity action call, but first I'd like to mention that, as Jeremy mentioned, we do believe a large allocation to a tactical fund such as this is going to help you through turbulent times. For example, a 25% allocation of this fund within an existing 60-40 portfolio would do the following. If you say took 10% of your current equity holdings and 15% from your fixed income holdings to generate that 25% and put that into this fund into that existing portfolio, what you would have is a 65% equity sleeve and a 35% fixed income sleeve during the green zone. What will automatically shift is, with what happened recently moving into the yellow, what your portfolio would automatically shift to is a 60-40, 60 equity, 40 fixed income. And then if the equity action call did move into the red zone, what your portfolio would then become was a 50-50. So that tactical shift automatically happens within the portfolio during uncertain, turbulent times. So I just wanted to point that out on an allocation. On the next slide here, this gives you more of a picture of what happened recently. So on October 9th, after the close of the 8th, where the equity action call moved to that yellow zone, we shifted this portfolio from a 60% equity, 40% fixed income into now a 60% fixed income and 40% equity. And the fixed income portion of this portfolio, not only over the last month or even 3 months, but for the last year, has been a big contributor to performance for this fund. If we go to the next slide here, we'll actually take a look at the that fixed income portion. We have a separate fund also. It's the BMO Tactical Global Bond ETF Fund. And you can see here from the performance numbers that we've had a lot of strength over the last year. And really it's because of the holdings that this has held. For those who aren't familiar with this fund, we currently have a 75% exposure to US bonds and a 25% exposure to Canadian. And on both sides of the border, there's a lot of similarities where the bulk of this entire portfolio is investment grade corporate bonds, and corporate bonds in that mid duration. So most of them are in that 7 to 8 years. So it's really been the sweet spot, especially with what's been happening on both sides of the border with the Federal Reserve and the Bank of Canada at one point a year ago saying something completely different to what we're seeing now. So there was a lot of swings in the bond market, and we found that the holdings we had, and of course these were the top ranked names within our investment universe, fared very well with this uncertainty. So again, this has been a big part of what we saw within the asset allocation fund, but as a standalone bond also. This could be seen as a great tactical sleeve within a overall fixed income portfolio. Looking at the next slide here, we're going to have a look at the other portfolio, or the other new fund that Jeremy mentioned. We don't have any performance metrics on this one yet because it's just under a year old. We're closing in on that December 7th date. But just to point this one out, this is one you're going to want to consider because it has a very low correlation to most anything else in Canada. You can see by the holdings here, you're not going to see any big banking names, any big energy names, and the only material name is the Wheaton Precious Metals. And I mentioned Wheaton because this is when we saw the change in the equity action call on the 9th, nothing specifically changed with this. But a week ago, last Wednesday, Wheaton was sold. We hit a sell we hit a sell signal for that individual position, and while we're in the yellow zone, the rules for this fund and many of the other ones is that if an equity position is sold, we're not going to replace it with the next highest ranked equity. We're going to replace it with a short-term bond, and that's exactly what took place last week within this. So we sold the Wheaton Precious Metals and moved that proportion of the 1 of the 15 holdings into a short-term bond fund. And the next slide will be another example of a similar move. This also held Wheaton Precious Metals. This is our BMO SIA-focused North American equity fund, so it's comprised of both Canadian and U.S. names. But with the equity action call, since we sold the Wheaton also, same thing. We moved into a short-term bond fund, and it will remain so until we move back into the green zone. So again, like Jeremy mentioned, the yellow zone is not, it's more of a cautious signal. While we wait, more times than not, it does move back into the green zone. So we're going to hold cash until that happens. And then the last slide is our fifth fund, the BMO Tactical Global Equity ETF Fund. Throwing this up here because as of yesterday's close, with the equity action call change, nothing has changed in this portfolio. This portfolio holding broad-based, sector-based ETFs as well as individual names. If any of those individual ones are signaled to be sold, similar to the last two funds, we'll hold short-term bonds until we move back into the green zone. And that covers the equity action call changes for these. Here's a snapshot of the codes and fees for each of these funds, and I'll pass it back to Ted for any questions.
I've actually got the questions on my side here, so thanks, Paul. One of the questions we've got here is in the asset class rankings, what's the meaning of currency? I'm just going to flip back sorry for jumping around here, but currencies, when we look at them in our asset class rankings, really just fixed income products in other denominations other than US dollar or Canadian dollar. So we're looking at that international or space to look and see what's happening with fixed income out there. So currency had been weak. We can see on the left side, July 19, that bonds, which is where we're measuring our US and Canadian fixed income, is in third position, but currency is ranked poorly. We've now seen the opposite where currency has moved up. So that really, I think, is just speaking to some of the problems that we've seen internationally, and it really shows up with the Canada being #1 and US equity #2 and international equity #6. So that's one of the nice ways to measure. It gives us more conviction when we reduce our international exposure in a time like this, because we can see currency is not ranked as well. The other thing I wanted to mention too, and it's a question that I've got a number of times recently, is, we've seen some great index performance through 2019, and maybe, SIA products are hanging in just above or just below those benchmarks. If we take a look at this SIA market equal weight index, we can actually see that it is really just at the same levels that it was back in February of 2019. So if you look at the global market, if you look at the entire world in one view, the SIA Charts Market Equal Weight Index is a good representation that it's been more difficult through this year to get that. So it's been a narrower focus, particularly mega caps up there. So outperformance is a little bit trickier to get in that environment than when you have a situation where this is rallying. So given that that's been the case, and in the yellow zone, it makes it more important to follow that asset class rankings, those relative strength indicators, because the trouble and the movement around, just as what happened with international, can happen very, very quickly. I think we've got another question here, and I'll let Paul Van Drinsky answer this. With the North American portfolio ZFN, did the Canadian weighting change from July along with the EAC?
As far as Canadian names, like the equity action call didn't change until very recently. So since July, we've had a little bit of turnover in the fund. The only one I can think of as far as getting out of a Canadian name is when we sold Shopify in mid-September. That would have been on the commentary in early October if you got it, but we did sell Shopify and buy Texas Instrument. So that would have been one less Canadian holding as far as I can remember. And just to mention, Shopify was a position we picked up in February when we went back into the green zone, held from February till mid-September, and made, I believe, just over 100% return on that, 105, I believe. So that was the only Canadian trade as far as I remember.
Perfect. We've got another question. Do you have any recommended ETFs to play the currency recommendation? Well, we don't have any in front of us with SI Wealth. One of the prohibiting factors that we have when using currency exchange traded funds within our portfolios is that they may be done through a derivative, which we're prohibited from using in the portfolios. But what you can do is, if you're a subscriber to SI Charts, we do have a currency ETF ranking within the system, and you can go take a look at that. I'll try to pop it up just quickly while we're still on the screen here. I apologize, I've been locked out for right now. But take a look at that, and the gentleman who asked that question, I'll reach out to if I can. I'll get that link for you and get some information for you on that.
Jeremy, if it's okay, I'll just jump in. I misspoke about the return. We made about 100% return on the Shopify position in the ZFC. ZFN was about 50% because we bought that in March, but it was the same trade as I mentioned.
Gotcha. Okay. Excellent. With that, I think we've answered all the questions that have come out. Like always, if you have any other questions, please let us know by email or by phone call. We're always available. We have got a strong and robust team here. So we thank you again. We're going to return to our regular scheduled webinars. You'll likely see these once a month going forward. The summertime became a little bit slower, and with people away, we left that alone. But the yellow zone, just in conclusion, at this time does not appear to be as fearful. We still have Canadian equity and U.S. equity on the top. We're just got to be cognizant of what's happening internationally and to see if this spreads over our markets here. But in the interim, while we wait and watch that, we do have to be defensive. We're going to hold a little bit more cash as we sell positions. But take a look at those three positions that we have: our Canadian equity, our tactical bond, and our tactical asset allocation are all three great products to be looking at during this yellow zone time. So thank you again for your time, and we look forward to speaking to you in the near future.